Many investors get into the real estate game for the income potential that real estate investing can provide. And when it comes to measuring that income, the projected cash on cash return is one of the best barometers out there for how a deal might perform. The cash on cash is one of the most heavily scrutinized return metrics in all of commercial real estate, alongside the IRR and the equity multiple. But similar to those two metrics, the cash on cash return has a few big nuances that are really important to consider before relying on this figure within an investment analysis. So to take this concept deeper than just the standard mathematical calculation, in this video I want to talk through the details of the cash on cash return in a real estate context, specifically what this figure is actually telling us and what should and shouldn't be factored into this metric when using this to analyze a real estate deal. So to step back and first define what the cash on cash return actually represents, this figure measures the net cash flow distributed to investors on an annual basis divided by the total equity invested in the project up to that point. This means that if you invest $1 million into a property, that property generates $100,000 in annual net operating income, and your total debt service on the loan is $40,000 per year. This leaves you with $60,000 left over after paying all expenses related to the property, resulting in a 6% cash on cash return on your initial $1 million equity investment. Many people that are new to the industry confuse the cash on cash return with another commonly cited metric, the cap rate, but the cap rate measures only the net operating income of a property as a percentage of the purchase price of the deal, ignoring debt service that will reduce the annual cash flow distributed to investors and ignoring loan proceeds that will reduce the equity investment required when the property is initially purchased. But even though these metrics are different from one another, this doesn't mean that these two figures aren't related at all. And the first thing about the cash on cash worth noting in this video is that this metric can be helped or hurt by leverage on a real estate deal depending on the loan constant of the debt in relation to the cap rate. The loan constant is a very simple calculation representing the total annual debt service on a loan as a percentage of the total loan proceeds overall. And because monthly debt service payments consist of both interest and principal portions, the loan constant will often be significantly higher than the nominal interest rate that's quoted on the debt. And to put this into context, let's take a look at a $6 million loan with a 5% interest rate amortizing over 25 years, resulting in debt service payments of approximately $421,000 per year. And this $421,000 figure doesn't represent 5% of that initial $6 million loan amount, but more than 200 basis points higher than that nominal interest rate, with the loan constant on this debt coming in at 7.02%. And how this comes into play for the cash on cash return is that when the cap rate is higher than the loan constant, debt will increase cash on cash returns, a scenario which is commonly referred to as having positive leverage. And when the cap rate is lower than the loan constant on the deal, debt will decrease the cash on cash return, resulting in negative leverage on the property. And to show you an example of this in action, if we take a look at a deal purchased for $10 million at a 6% cap rate, if we calculate the cash on cash return on an unlevered basis or without debt, we also get a cash on cash return of 6% on the deal. However, if we assume we buy this property with an acquisition loan at a 60% LTV ratio with a 5% interest rate amortizing over 25 years, that cash on cash return now drops to just 4.5% going into the deal, and assuming 3% annual revenue and expense growth over a 5-year period, the average levered cash on cash return in this scenario is a full 100 basis points lower than the cash on cash would have been without a loan in place. The point here is that just because the interest rate on a loan is lower than the cap rate on a deal, this doesn't necessarily mean that debt is going to be accretive to returns, and the delta between the loan constant and the cap rate is what's really going to drive the cash on cash metric. Now, speaking of debt, the next thing worth mentioning about the cash on cash return is that aside from just the loan constant on the deal, the cash on cash is also heavily dependent on leverage levels on the property or the total loan proceeds in relation to property value. For deals with positive leverage, the higher the loan amount, the higher the cash on cash return is going to be, since increases in loan proceeds decrease the total equity investment required on the deal, reducing the denominator within the cash on cash calculation. And using that same example we used earlier on in this video, but now assuming the property is acquired at an 8% cap rate, giving the deal positive leverage at a 60% LTV ratio, the levered cash on cash return in the first year of the hold period would be 9.5%. However, if that LTV were to jump to 70%, that year one cash on cash would increase by 80 basis points up to 10.3%. If the LTV were to jump to 80%, the cash on cash would increase by 160 basis points to 11.9%, and at a 90% LTV ratio, the cash on cash return would jump by 500 basis points to almost 17%. And while a 17% cash on cash is obviously more attractive on paper than an 8.5% cash on cash yield, this differential says nothing about the risk associated with taking on a loan at 90% of the value of a property and the significantly lower margins that exist at this level of leverage. To put this into perspective, on this sample deal with a 60% LTV loan, revenue at the property would need to drop by over 38% before investors would find themselves in negative cash flow territory, which is a pretty significant cushion if occupancy rates were to dip or rents were to decrease in the market as a whole. However, at a 90% LTV ratio, if revenue were to drop by just 17%, operating expenses and debt service would exceed the income generated by the property, which exposes investors to a much higher risk of big downward swings on the cash on cash figure and future capital calls if economic conditions were to change in any meaningful way. The key here is to not take a cash on cash return entirely at face value and to make sure you understand the operating risk you're taking on in exchange for increasing that cash on cash yield at higher and higher LTV levels. And then finally, the last thing I want to mention in this video about this metric that's really important, especially when creating investor materials, is that the numerator of the cash on cash formula only includes cash flow from operations and does not include cash out refinance or sale proceeds. Investors rely on the cash on cash return to get a sense of the income a property is expected to generate, and especially for high income earners that might be looking for this deal to help fund their cost of living during retirement, this metric needs to represent a reliable dividend yield that can be expected by investors in the form of distributions made on a regular basis. Sale proceeds and refinance proceeds are extremely speculative, especially when these events are projected to happen 5, 7, or 10 years into the future, and investors rely on metrics like the IRR and the equity multiple to understand the projected impacts of these capital events and don't expect these to be included within the cash on cash return. Adding sale and refinance proceeds would also drastically impact the average annual cash on cash figure, which is very commonly included in investor materials. And if these investors are looking to this metric to represent a predictable annual cash flow yield from operations, this would lead to a lot of confused and frustrated investors when distributions started to be sent out. Ultimately, the cash on cash is intended to help investors compare a real estate deal to other dividend yielding investments at their disposal. And if you take the time to dig a little bit deeper into whether a deal has positive or negative leverage, how loan proceeds are impacting returns, and you make sure to only include cash flow from operations in the numerator of this calculation, this can be a really helpful tool to analyze a deal. And if you want to learn more about the cash on cash, IRR, equity multiple, and other real estate finance metrics that are commonly used within an investment analysis, and how to build acquisition and development models from scratch in Excel, as always, make sure to check out our all-in-one membership training platform, Breaking a CRE Academy. A membership to the Academy will give you instant access to over 120 hours of video training on real estate financial modeling and analysis. You'll get access to hundreds of practice Excel interview exam questions, sample acquisition case studies, and you'll also get access to the Break into CRE Analyst Certification exam, which covers topics like real estate pro forma and development modeling, commercial real estate lease modeling, equity waterfall modeling, and many other real estate financial analysis concepts that will help you prove to employers that you have what it takes to tackle the responsibilities of an analyst or associate at a top real estate firm. And if you like this video and want to see more deep dive content like this on different real estate finance metrics, make sure to hit the like button to let me know, and let me know in the comments what other topics you'd like to see more of this year on this channel. As always, thanks so much for watching, guys. I hope you found this helpful. Subscribe to the channel if you haven't already to see more videos like this every single week, and I'll see you in the next video.